Hello, welcome to Challenge JP. My name is Jacek, and today I want to give you a very quick overview of an extended financial model template that I've just put together. If you want to download the file, just follow the link on the screen or in the description of this video. Okay, so if you open the file, you should see contents page, table of contents, which is a very good thing to always put together at the beginning of the model and which allows for quick and easy navigations around the model. That's useful, especially with a lot of different sheets. The contents page is followed by assumptions. There you go. And assumption is a page where you list all the drivers behind your market share, your revenues, cost, and so forth, and so on and so forth. So it's always a good idea to keep all the drivers in one place. Add some notes maybe to the right over here, so you can explain actually what's the basis of your assumption. It's then easy to share it with potential investors or just print it out for yourself. That page is followed by the cash flow model. Okay, now I won't go into too much of a detail of different calculations being used in this model, but that's basically where this is the place where we use the assumptions from the previous page and then apply them to timeline and then create all the calculations that are driven by those assumptions. So for example, let's go to this line over here. This model assumes that let's say you're selling an app, you develop an app, and you've estimated the potential market share of users that are potentially going to download this app, and then you also have some assumptions around the uptake, right? So what you're saying is that by year 3 or by year 5, you're going to get 10% market reach, which then translates into a number of users, and then those users will be downloading your app. They will be paying some upload fees, some recurring fees, which then that generates revenues, also drives some marketing cost, and so forth, and so on and so forth. So that's this is the place where all those calculations happen. If you want to get a bit more detailed understanding of how to create this page, you can follow the link on the screen and go back to one of my tutorials when I deal with creating a simple cash flow model. This is where I spend a bit more time on explaining how to put the assumptions and cash flow model together. Okay, let's flow by the summary page. So the summary basically just aggregates all those numbers, all those monthly numbers into a yearly overview or quarterly overview, whatever your requirement is. At the bottom here, I've also put a very quick calculation of the returns. So it just takes your cash flows from given years and also applies some calculations at the end of year 5 to value the company. We're assuming that year 5 is when the company will become a bit more mature. So this is where I can actually apply some valuation to it. And that allows you to show the returns of the company, also your present value, and then potentially the cash requirement. So this cash requirement is, well, basically it's how much money you need to fund your business. Okay, that's followed by some graphs. It's always important to have a graphical visual representation of your numbers, so you can then copy and paste it to your PowerPoint presentation or whatever folders whatever the materials you're preparing for your investors. Okay, so that's all quite what we call simple modeling in here. And then I've added a few additional sheets in here. So first of all, we have our discount cash flow calculation. Again, without going into all the details of formulas used in this model, what discount cash flow calculations show is the present value of your future, of the money that the business is supposed to generate in the future, right? And you will see that we're applying at different discount rates. So we just basically take the future values of the company, also what we call the terminal value of the company. So this is again the valuation of how much the company is going to be worth, let's say in the year 5, and then we want to bring it back to what that means in today's money. In other words, it's another method of valuing the company and seeing how much all those cash flows that you put together in the model is worth today. Okay, so that's exactly what it's done in those lines in here. That again gives you the IRR calculation. It's going to be a little bit different than the calculations in here. Again, the DCF is a bit more detailed, more sophisticated calculation method used for valuation. And what I've also did in here, put together a simple capital structure. So what this capital structure allows you to do is it assumes that you will have two tranches of investment. So you will have, let's say, a Series A. You will have the investors coming at the very beginning of your lifetime of your business, and then you assume that that investment will be followed by another investment maybe in a year or two when the company is slightly more mature, but there's a bit less risk in the company itself. And that table basically just shows you the returns. It splits the ownerships between the different investors, and then it shows the potential returns for different tranches of investment. Right? It's a little bit more complex. Most of the time, it's probably not going to be needed in your first when you present the model for the first time, but it's probably something that people will be looking into down the line as a conversation when investment progresses. So it's something that's useful to have the model. Let's go further here. I've also added some detailed P&L statement, cash flow statement, and balance sheet statements, right? So the P&L is basically taking, most of the statements will be taking all the information from their link to a cash flow, to the cash flow model sheet, but it just presents it a bit better. So it gives you actually a proper kind of accounting format for the P&L statement. It shows you things like depreciation, amortization, interest. The cash flow statement is divided into cash flow from operations, cash flow from investing activities, financing activities, and then the balance sheet just reflects your assets and your liabilities in a given time. Again, you probably won't be asked for that at the very, very beginning. First, you probably want to focus on those first few sheets, right, all the way to your summary sheets and graphs. But then later on in the future, that's something that you will potentially be asked for, right? And then I've also added as a bit of an extra here a debt model. So this model assumes that sometime in the year 3 of the business, there's enough cash flows, there's enough maturity in the business, so you can actually go to a bank and ask for a loan. And that's exactly what this sheet does over here. It assumes that you will receive a certain amount of loan, and using the assumptions around your interest rate, also the term of the loan, it then gives you what we call an amortization profile. So it basically shows you, okay, well, of the payment that you will have to make, how much of this payment will go into the interest, how much of this payment will go into a principal repayment, so how much actually of your debt will be reduced by, and then when the debt will be paid off. That's also linked to your balance sheet, so you can also see at a given period of time how much debt you actually have in a company. Okay, so that's the model itself. I want to very quickly go back to the assumptions page, because you will see, you might have noticed that there's actually 3 different columns for assumptions, right? And this is where we start introducing scenarios. Let's say that you want to see how a change in a given assumption or given driver influences your returns or your cash required in your business, which is the metrics that I put in here. What you can do in here, what this model allows you to do, it allows you to, for example, if you go to the market share, it allows you to say, okay, well, I want to have a scenario where I have 5% market share, 10% market share, 15% market share, percent market share, and I also want to have a different revenue assumption, so 390, 290, and 240 under a different scenario. I've created a switch in here, so you can choose which scenario you want to apply to the model. You see, if I click on that arrow in here, it will give me a choice 1, 2, 3. Let's say if I choose number 3, okay, number 3 is my current scenario. We'll have a column over here that shows the current assumptions used, my active scenario. And since I use 15% for my market share information, for my market share assumption, that's the active assumption used at the moment, and that's the assumption that's going to be linked over here to your cash flow model, right? So you can then look in here in your returns, you can see that how those different scenarios influence your returns. Okay, very useful. It's something good to have. It's always good to understand what are the key drivers behind your revenue, behind your returns, right? How sensitive, in other words, how sensitive is your model to your assumptions around, for example, pricing or your market share? Because if you present a model, you are most likely going to be asked for different scenarios. Investors will always assume that your case is probably optimistic, and they want to see, okay, well, what happens if let's say your market reach assumptions are not as good as you think? What happens if you, let's say, reach half of the users that you plan to reach? So it's always good to you run those cases first before you present, so you actually have probably those answers with you. Okay, from the technical point of view, from one of the formulas that I use to create this scenario, I've used here an index formula. So that formula, it's basically, you can use different formulas for that as well, but my preferred one is index. It basically just says, okay, well, stay on this row over here, and then using if I stay on this row over here, take this row C to E, and then choose the column number depending on what value I use in that cell C6, right? So in this case, for example, I'm saying stay in this row, choose this row, and then take the value from the column number 3, which is 15%. That's being fed into the model, and it drives the rest, right? So the beauty of this model is that everything is linked in here, right? And this is how you should always have that model. Start from the assumptions, start from the cash flow model, and then link the summaries to the cash flow model. And then this is also the sheet that links to those other calculations in here, right? So once you have nailed that first part, then it's easy for you to add additional sheets depending on the requirements that you may have. Okay, that's it. I hope you enjoyed the presentation. Obviously, if you have any questions or comments or suggestions, please email me at contact@challengejp, or if you're on YouTube, you can just leave comments in the comment sections. All right, thank you very much.